A long time ago, a wise man once referred to financial derivatives as financial weapons of mass destruction. In 2008, we have seen how massive these destructions can be. Weak regulation, lack of transparency, and greed within the derivatives market caused a global financial crisis that many of us still remember. We can see the same narrative playing out again before our very eyes. And what did we do? Christine Lagarde, the president of the European Central Bank, once said that the challenge of regulating a global industry such as crypto requires thoughtful consideration, balancing the need for security with the potential for a more equitable global economy. Globalisation is a double-edged sword. While it can have its benefits, once triggered, a crisis often leads to global instability in markets. Increased globalisation leads to higher volatility. As markets become more integrated, fluctuations in one market can have a ripple effect across the world. Due to the increased interconnectedness between countries, governments struggle to supervise such markets. Cooperation often relies on international organizations that might agree on principle, but often disagree on details and implementation. Financial globalization can lead to greater inequality as some countries and individuals benefit while others suffer. With an increased number of institutional investors and over 4 billion internet users now able to access the cryptocurrency market, increasing their use across the globe, the possibility of a global crisis remains. The New York Digital Investment Group estimated that around 14% of Americans now own cryptocurrencies. Attitudes have shifted. As cryptocurrencies appear to have become more normalized, fewer crypto users regard them as a gamble and more see them as an alternative or complement to mainstream investments. Yet the derivatives industry for cryptocurrencies goes far beyond these retail-driven instruments, as institutional investors can also benefit from using such instruments to hedge their positions in the crypto market. The derivatives market now makes up 69% of total crypto trading volume. The risks posed by crypto derivatives are escalating and have a potentially destabilizing effect on financial stability. Institutional traders use these instruments because they offer the possibility to create semi-fixed income strategies. By combining call and put options, traders can set an options trade with predefined max losses without the risk of being liquidated. George Soros once said that there are so many derivatives and some of them so esoteric that the risk involved may not be properly understood even by the most sophisticated investor, and I am supposed to be one. The complexity of cryptocurrencies is often overlooked by the ease of investment, yet this complexity is unmistakable. To understand the speculative nature of crypto derivatives, one needs to take into account the underlying technology of the blockchain. In addition, investors need to consider the delicate task of risk assessment analysis for a speculative instrument which may make the consideration of cryptocurrency a puzzle far too intricate for the human mind. George Soros's words still ring true, and the same can be applied for crypto derivatives. We are dealing with a very complex instrument, one that must be approached with caution and respect, but this is only half of the story. Due to the complex payout structures of these products, investors will have a hard time comparing them with each other. When you don't know what the competitor across the street is offering, you will have a hard time understanding whether or not you have a good valuation. When prices are not fairly disclosed and comparable, the time is short and you will likely pay too much. Such markets are called dark markets that make profit from the fact that you don't know how someone else would have charged you for the same product. Complex structures and long contractual agreements will make it impossible for you to understand and compare the different products to each other. Vitalik Buterin once said, "The emergence of cryptocurrency and blockchain technology is the chance to break the monopolies in the market, allowing for the democratization of money and freedom of transactions." But does it really? Binance is the largest crypto futures exchange, accounted for nearly half, 47.6% of total volumes in crypto derivatives. Monopolies in the crypto market can be dangerous because they can lead to market manipulation, price fixing, and the exclusion of competition. Monopolies can also lead to a lack of innovation and higher prices for consumers. Monopolies in the crypto market are antithetical to the decentralized and autonomous nature of the technology and should be avoided at all costs. Only by allowing competition and open access to the market can we truly foster the robust and innovative innovation that crypto was intended to provide. Walt Lucan, President and CEO of Future Industry Association in the United States, stated at the FIA Boca conference, "As a former regulator, I try to look at products without projecting moral judgments onto whether they are good or bad for society. Instead, I believe in the wisdom of crowds and allow markets to make such determinations." In order to guarantee the free will of market participants, we need to focus on the core principle of what makes a healthy and safe market. Markets should maintain their integrity so that price discovery and hedging can function to help drive commerce and allocate capital. And most importantly, markets should be fair. All participants should be treated the same for the activities that they perform, the risk they generate, or the products that they trade.